Hi, my name is Gloria Glidden, Head of the Banking Supervision Division of the Cayman Islands Monetary Authority, or CEMA. Today, I will present a summary of the results of the Banking Sector Risk Assessment, SRA for short, conducted by CEMA in 2019. The SRA includes an assessment of the risks of money laundering and terrorist financing in the banking sector under the supervision of the authority. Firstly, I will provide a background and overview of the banking sector, followed by an overview of the combined sectoral risk assessment. Next, I will explain the risk assessment methodology used. I will then provide a summary of the banking SRA, followed by a summary of the inherent risks. I will end the presentation by sharing the key takeaways for licensees. In 2019, CEMA conducted a combined sector risk assessment of the risks of money laundering and terrorist financing in the various financial sectors under the supervision of the authority. In addition to the information provided in the combined sector risk assessment, the purpose of this presentation is as follows. Firstly, to identify and assess in more detail the money laundering, terrorist financing risks faced by the banking sector in the Cayman Islands. Secondly, to evaluate the risks from a sectoral perspective. So it's not intended to cover risks that may be specific to the circumstances of individual banks. And thirdly, to assist licensees in their efforts to augment their business-wide risk assessment and their development and application of a risk-based approach to compliance with the anti-money laundering regulations and thus towards combating money laundering and terrorist financing. All banks in the Cayman Islands are licensed and regulated by CEMA in accordance with the Banks and Trust Companies Law and are authorized to provide the full range of banking products and services. There are three types of banking licenses, with the primary distinction that Category A banks may provide services to both the domestic and international markets, whereas Category B banks are only authorized to provide services outside of the Cayman Islands. Most banks with a Category A license offer retail and commercial banking services to local residents in the Cayman Islands. Category B banks are restricted from engaging in banking business with residents and thus cater mostly to customers outside the Cayman Islands. Category B banks perform a number of activities such as private banking, treasury management, trade finance, and wealth management. A restricted Category B license limits business to named customers outside the Cayman Islands, which usually have some connection with each other, that is, companies within a group. Banks in the Cayman Islands vary greatly in size, from small entities to those with large global footprint. The majority of the sector is comprised of Category B banks, conducting treasury services for group branches in the Americas. The domestic market is serviced by 6 retail banks that, combined, represent less than 15% of total sector assets. As you can see from the slide, as of September 2019, the number of Category A banks was at 10, the number of Category B banks was 122, and the total number of banks 132. Banks by category, there are 81 branches, 36 are subsidiaries of international financial institutions, and 15 affiliates of international financial institutions or private banks. From a geographic perspective, most of the banks licensed in the Cayman Islands are branches or subsidiaries of established international financial institutions conducting business in international markets. Risk assessments were conducted on the sectors listed below on the slides. Those included banks, Category A and Category B banks, money services businesses, trust and corporate service providers, insurance, mutual fund administrators, securities licensees, and securities and investment business law registered persons, that is, previously defined excluded persons under the securities and investment business law. A summary of the sectoral risk ratings was published on the CEMA website as the Combined Sectoral Risk Assessment on the 13th of March 2020, and the link has been provided in the presentation for reference. The banking SRA examines the inherent money laundering, terrorist financing risks that the Cayman Islands banking sector faces. Inherent risk is the risk that a particular product or service, customer, delivery channel, or activity poses, regardless of the bank that offers it and any risk mitigating controls that may be in place. This approach allows for the creation of peer groups and for the benchmarking of expected controls. The actual controls in place will vary significantly from bank to bank and are expected to be commensurate with the inherent risks that each bank faces. Risk factors are based on the inherent risk areas recommended in the FATF 40 recommendations, namely the following: nature, size, and complexity of the sector, transactions, products and services, delivery channels, types of customers. Geographical risk factors are considered in the context of each of these categories, as geography is an overarching dimension of each risk category. All these risk factors combined provides the overall inherent risk. The banking SRA was conducted for Category A and Category B banks separately, given the uniqueness of these two subsectors. Based on the previously mentioned inherent risk factors, each subsector of the banking sector has been given one of the 4 risk ratings: low, medium high, high, as well as an overall consolidated inherent risk rating for each subsector assessed. The table provided on the slide provides a summary of the inherent risk factors for Category A banks and for Category B banks overall. The next few slides will explain the rationale for the risk ratings assigned for each risk factor within each subsector. Based on the summary, for Category A banks, for the inherent risk factor of nature, size, and complexity, they were assessed as low, whereas Category B banks was assessed as medium-high. For transactions, products, and services, Category A banks was assessed as medium-low and Category B banks medium-high. For delivery channels, both Category A banks and Category B banks were assessed as medium-low. For types of customers, Category A banks was assessed as medium-low and Category B banks high. The overall inherent risk score was medium-low for Category A banks and medium-high for Category B banks. For the inherent risk factor for nature, size, and complexity, Category A banks was assessed as low. Key inherent risk score considerations included the fact that Category A banks have a strong local presence, they cater predominantly to the domestic or regional economy, they have limited structural ties to high-risk jurisdictions, versus the Category B banks, with their international nature of their business, complexity of many group bank structures, significant number of licensees with no physical presence, and international control and ownership structure. Therefore, Category B banks, for the nature, size, and complexity inherent risk factor, was assessed as medium-high. For the inherent risk factor for transactions, Category A banks were assessed as low versus medium-high for Category B banks. Key inherent risk score considerations included a lower proportion of cross-border transactions for Category A banks versus almost 100% cross-border transactions for Category B banks. Products and services, both Category A and Category B banks were scored as medium-high, and this is primarily due to the volume of high-risk products and services. Overall score for the inherent risk factors for transactions, products, and services was medium-low for Category A banks and medium-high for Category B banks. For the inherent risk factor for delivery channels, both Category A banks and Category B banks were assessed as medium-low. Online onboarding and reliance on non-group introducers is limited. Introduction within the group is very common. The money laundering terrorist financing risk therefore depends on the level of compliance within group entities. The risk is partially mitigated by the fact that group entities that provide introducing services are in countries with well-established regulatory regimes, non-high-risk countries. As such, the risk for delivery channels has been rated medium-low for both Category A and Category B banks. For the inherent risk factor for types of customers, Category A banks have a medium-low customer risk exposure due to the client profile of their customers. Most customers are natural and local persons, and there is limited exposure to high-risk customer types, such as foreign PEPs, high net worth individuals, etc. Customers of Category A banks have a lower geographic location risk exposure, with only a few customers being from a high-risk country. The assessment for Category B banks results in the rating of high in regard to customer risk exposure. The risk drivers are the almost exclusively international customer base and the large percentage of high net worth individuals, PEPs, foreign beneficial owners, and corporate customers. While there are a large number of Category B banks that focus on foreign institutional group or non-group customers, and as such pose lower risk due to being licensed, regulated, and supervised abroad, there's a small institutional client base that stems from predominantly regional high-risk countries and increase the risk in this category. The customer assessment has also been considered high net worth individuals that do form a significant share of Category B banks' customer base. From a geographic perspective, the exposure of Category B banks to high-risk countries is limited, with customers coming mostly from non-high-risk jurisdictions or, to a limited extent, from high-risk jurisdictions in the region. Key takeaways for licensees. Entities should consider the banking SRA in conducting their institutional money laundering terrorist financing risk assessments, including their customer risk assessments, and in taking measures to applying a risk-based approach, including risk identification and assessment, designing your AML CFT program, inherent risk categories should be considered in your risk-based approach, inherent risk score drives risk management and mitigation, and vigilance. Customers from countries with weak or insufficient AML CFT systems should be considered very carefully. Key elements of the risk-based approach. The risk-based approach has 4 key elements. First, identification and assessment. Second, management and mitigation. Third, ongoing monitoring. And fourth, documentation. Identification and assessment. Identifying AML CFT PF risk based on 4 principal factors: customer, products and services, delivery channels, and geography. Management and mitigation, identifying and applying appropriate measures. Ongoing monitoring, implement policies, procedures, and IT systems. And documentation, document risk assessment strategies, policies, and procedures. I have included this slide for additional reading with key references and resources, many of which you will find published on the authority's website. Thank you. If you have any questions on this session, please contact the Cayman Islands Monetary Authority by sending an email to contactamlcft@cema.ky.